Victor Yang, Senior Analyst at JLC Network Technology. Maliha, let's start with you for a bit of a wrap on or opinion on the oil markets. I mean, continuing to be sort of steady and stuck, I suppose, in this $80 to $85 range, no matter what, you know, on headlines of interest rate expectations, the geopolitics, etc. But we're just not budging. Do you see anything that could take us out of that band in the next 3 months?
Thank you, Diala, for having us on. Very interesting. So the oil market is stuck in a range primarily because the demand has been muted. Prices should have been lower because since OPEC and Saudi have kept, 3 to 5 million barrels of the market, that's why oil price is staying stable. So the oil price really is stuck right now. The main thing is demand. Most of the sell-side equity analysts or commodity analysts predict a massive recovery, including OPEC, but those demand expectations are just not coming to fruition, and hence the prices are stable. But if you take a step back out of other sectors, like look at copper or nickel or uranium, there's a lot of activity in commodities because those are primarily very supply-driven markets. So we can assume that the markets are looking at it the right way, but the oil markets, really, there's no shortage. Look at the product markets. Your demand has been quite weak. Your gasoline inventories, your distillate inventory. So the market really hasn't picked up on that. And that's why we need to take a view on the macro. Right now, the big dilemma in the market is, do we see a recovery in US? We are seeing signs of US GDP growth rolling over after all the fiscal stimulus juice, as I call it, is running out of steam. And obviously the Fed's being over dovish for the wrong reasons as they pivoted. So the market is very optimistic on the macro side, but they're very pessimistic as to how the data is becoming more stagflation. And we can talk more about that. But the oil market really stuck with that. Demand is the key issue here, not supply.
Okay, thanks, Maliha. Laurie, good morning again. I mean, let's talk a bit about other impacts on the oil price, which is, usually geopolitics. Many people saying over the last couple of weeks or more that risk premium has just completely disappeared in terms of the impact on the price, in terms of the impact on any blockage of supply. I mean, we don't see a respite in the attacks on Gaza, and we have seen a lot of escalation in terms of international condemnation of what Israel is doing. Do you see that coming to anything from a practical point of view?
Look, I think like the oil prices have been tested with all sorts of geopolitical incidents and geopolitical accident, even like that accident that happened, tragic accident with the Iranian president and the Minister of Foreign Affairs, and the prices were not like were like stable, right? So I think so everything has been tested regarding geopolitics. Yeah. So therefore, like that's why everyone thinks that, okay, we're past that. It all goes back to the fundamentals now more than the geopolitics. And what we are seeing, as we said before, like what's happening in Israel and with the Israelis and the Palestinians, with all the atrocities now that we are seeing, does not have an impact on the oil prices. The only impact is like if there is physical attack on supplies, and that could be something that could really have an impact on the prices. Before, nothing like, if nothing is happening on that side, we're not going to see much happening on it, and people will still be looking at supply, demand, etc. And as Maliha said, there's a lot of supply and the demand that we've been talking about since last 2022 and then again 2023 we haven't seen it, and we still continue with the uncertainties. And now going into the election seasons, I guess like maybe still wait like by end of November 2024 and the American elections, that could maybe have a bit of impact because of the future looking of what the new administration, whoever that administration is, going to take decisions on the oil and gas policies.
Okay, thanks, Laurie. I suppose, yeah, I mean, the geopolitics isn't, but we do have a headline which says the Houthis are back popping their head up again, saying they've attacked 3 ships, two US destroyers. That's a headline on our water. So I suppose that kind of response maybe to the escalating atrocities in Gaza could could cause a bit of, a bit more sort of, I suppose, nervousness in the markets in the coming week or two. Victor, glad to have you with us. I believe that you can hear us now. You were having a bit of problem with your audio earlier. Let's talk about demand, because Maliha mentioned demand. We've got another headline saying OPEC is still very optimistic about demand for its oil in the second half of the year. Give us the point of view from China and how that's looking in terms of manufacturing, in terms of demand for oil in China in the second half of the year. And you're on mute. You're going to have to unmute yourself. Yeah. Still on mute. We can't hear Victor. You're still, I can see the mute sign there. Okay, we'll wait for him to sort that out. Ah, there you go. You're back. Okay, hi, Victor. Yeah. So the demand outlook for China second half of the year.
As well. And let me see. And can you hear me now?
Yes, we can hear you.
Yeah. And it's now quite stable at this moment. And for this moment, China's refinery maintenance is at close to the peak, particularly for independent refineries. Now, they are run rate at about 2-year low independence, and they are not going up yet in June. But we are looking at a slight rally in July and afterwards. And for state-owned refiners, their run rate have been quite stable, but they're not going to rise anytime soon either. So for the second half of the year, we do not really expect a rise of the crude runs by state-owned refiners, because some of them had actually overachieved their annual targets in the first few months, such as PetroChina. As we said, well, earlier this year, PetroChina actually planned to raise its crude runs by only about 5.1 million barrels for the whole year. But in the first quarter, it already boosted its crude runs by close to 27 million barrels. So this means it has to cut its crude runs year on year in the coming months to achieve its annual target. And for Sinopec, it also raised its crude runs quite significantly in the first quarter. And now they are under quite heavy pressure from product sales such as gasoline, diesel, and jet fuel. And now their exports are not large either. In the first 4 months, their combined exports of gasoline, diesel, and jet fuel plunged, particularly, gasoline and diesel. And with diesel exports plunging by over 35% year on year. But their jet fuel exports surge. And so we are looking at much larger jet fuel export this year, which is helping to, boost their crude runs to some degree this year.
Okay.
But for the second half of the year, we're looking at the startup of a large independent refinery in Shandong, which is expected to be the largest contributor to the crude run rise this year, which is called Yulong Petrochemical. It aims to start operation within this quarter, so before the end of June. So we are looking at this one, see how soon it can start up, because it has got quotas on 8.3 million metric tons of crude imports for 2024, and it's expected to use up all this quota.
Great. Yes. So some support coming from that new Shandong refinery that's opening, and jet fuel seems to be coming to the rescue a little bit. If I can ask you, thanks, Victor. Maliha, let me go back to you a bit on, that's China demand, not very positive in terms of the import call on demand from OPEC for the next few months by the looks of it. And OPEC is also under pressure from increased non-OPEC supply that continues to hit the market. and take, I suppose, market share as long as these OPEC cuts stay in place. And has the market baked in the fact that these cuts are not going to change, at least for Q3? Is that your expectation? We have the meeting in 3 days, 4 days' time.
Absolutely. The market expectations for a rollover. What's really interesting is the topic of market share, because, Saudi had this sort of lollipop cut for, just a 1 month or 2 months. It's become like a year now. So the question really is, what is Saudi thinking? But we don't think they'll do anything, or they can do anything, as obviously oil prices need to be 90 plus for them to be happy. There could be some sort of an issue before the election. That's a bit of conspiracy, because you can argue that maybe Biden and, Saudi come to some sort of an agreement. But pulling aside from that, the thing on demand and China refineries, what people forget is that, the product markets, Chinese refineries, have been taking in oil, processing and sending crude exports out. So your gasoline and distillate margins were very high in Q1, and they've come back down. So China is actually a lot about arbitrage right now, but the demand overall has been weak. And the question is, supply is going to stay as is right now. Other than, Biden talking about adding to the SPR and a few things here and there really is not that much change. But the issue of the market share is a big issue, and no one's really addressing it. But I don't think they can do much right now.
Yeah. And I mean, I suppose, but also it will instigate probably more of a sort of screw in the discussions when OPEC does meet about, these increased capacity that the UAE, Iraq is essentially demanding at some point. And that, of course, is all to do with market share as well, isn't it? I mean, they've got all this capacity and everyone else is taking up the space in the market so far. Laurie, let's talk a little bit about Europe and just in the context of interest rates as well, because we've had some headlines in recent weeks that Europe is going to possibly move ahead of the US in terms of cutting. I mean, 1 or 2 banks have cut rates, but I mean, in terms of central ECB policy, that Europe is ready for that, needs that more. I'll go back to Maliha later about the Fed likelihood, but what's the mood in Europe at the moment on central bank policy, giving that sort of stimulus, if you like, into the economy, which is needed?
Look, not an expert on what central banks do, but I think the overall, if you want, discussions here, and especially the mood is like electoral mood, more of that, and there are concerns, and the economic concern is one. And the growth of the EU is very important, because it is an important part, and everyone is thinking about, with this Green Deal, etc., and the decarbonization of the economy in Europe, how competitive they can still be. And looking at the competition that is happening between the US and China, they feel they're kind of squeezed in between, yes, about economic growth, yes, about at the same time, saving the planet. They take it very personal that the European continent should be the one saving the continent, and the history of decarbonization should be written here. And these are the words of von der Leyen and the gang around von der Leyen. So I think they feel like there is a high pressure on how to become competitive again, and how this green energy will bring competitiveness and growth to it. At the same time, you hear all the voices about degrowth and changing the model of the economic model, etc., and the tension that is being played between the global north, global south, led by the EU vis-a-vis Africa and Asia and the rest, about this economic model. And the mood is basically that's the mood in the continent. It's about migration, what to do on migration. And then security, because as you know, Macron and the gang around him, they're talking a lot about security issues, military, how to spend on the military, and then you have the competitiveness. So these are the 3 major issues that are being discussed within the political parties, and we're waiting for next week. The elections are 6 to 9 June, and we'll see who is going to take over the European Parliament and what will happen to the Green Deal, and are there going to be backlashes or backsliding, or they will continue but with more we'll see with new policies, or we'll see what the new parliament will look like.
Yeah, and also, I mean, and in parallel, you have oil companies both in Europe and in America, continuing to sort of bring out headlines that they are continuing with investing in upstream, and that's required all over the world. Maliha, let's go back to you and talk. There's another headline on gold prices steady as traders brace for we've got the US inflation report coming out, and just and whatever that report says, I mean, has the market baked in that we've got 1 rate cut to go this year, possibly now with the election coming up, and not till September, perhaps not even till after the election?
So starting this year, we had about 6 or 7 rate cuts, just to put it in context as to where we are today. Today, we are oscillating between 1 and 2, and that probably would start September to December. There's a lot of talk about the Fed being political or apolitical. To be honest, let's look at the data right now. We think the Fed prematurely flip-flopped in December and went very dovish. There was no reason to do so. They sort of cut themselves, in the back of doing that. And now the data is actually turning out a lot weaker on the GDP side. The employment market is still holding up really well, but the actual PMI, the ISM services are rolling over, but inflation is actually ticking up. So we are stabilizing around 2.8, 2.9%. In some metrics, 3.9%. The rate of change is low from last year, but we're not going lower. Services inflation is high. Now with the price in copper and nickel and other commodities and oil prices, we're going to see inflation pick up. So the question is, what can the Fed do? The data is stagflationary. Powell actually did not admit that, but it is. So if they cut right now, I think the market's just going to lose inflation, right? And if they don't, the banks and the consumers need a cut. So there's a dilemma with the Fed. The banking sector and the consumers cannot afford these high rates right now. The US interest expense is 1.2 trillion, but who do they save? The consumer or the inflation? So we think the other banks are probably going to be cutting, like the ECB, and their economies are weaker. And the Fed, as we wrote a note last week, will be outdubbed by the other central banks. And I think that's really what's driving the dollar right now. Take a look at the yen right now. There's so many things happening in the Bank of Japan and the yen. The bond yields are going about 1%. So there's so much issue with the yuan, the PBOC, but the entire world is depending and waiting for the Fed to cut because they can't print more, they can't stimulate. There's a currency crisis, right now. And I think that's going to be very interesting to see how that plays out. If we are wrong, the Fed cuts, let's say tomorrow or this month, which is the wrong thing to do, different altogether, but they shouldn't cut.
Yeah, and I suppose it depends how much they want to stick to that inflation target. If they start to kind of start to massage that and adjust it to being okay at 1 or 2% higher, because they do have this debt problem, don't they? And so they're going to have to find a solution at some point. Victor, let's go back to you. Hopefully your sound is working okay. I mean, of course, China is also looking to do a lot of stimulus. It's doing, while the rest of the world tries to get a bit tighter, China's doing the opposite and trying to reboost parts of its economy, trying to get consumer confidence back. And you've talked to us about that before. But again, I mean, do you sense that we'll see a turnaround in the second half of the year with consumer spending and confidence?
Well, sorry for that. Yeah. And yes, well, and the economy boost is basically on the infrastructure large projects. And for this moment, it doesn't have much to do with the living of people yet. So most people would like to have more to do with the living of the average people. But one aspect is related to the people, more closely related to the people, is the down payment. When people buy the apartment for the first time, it has been cut to 15%. So the government hopes to stimulate people's purchase of apartments because the real estate industry is not doing well either this year. So the government is still taking measures to stimulate this industry. And for other sectors, it would be mainly focused on, say, construction, low construction, and other infrastructure construction, larger projects. So this can improve employment to some degree and spending, but not a lot to do with people's spending. Yeah, so, and we
Victor,
expect
let me just interrupt you there. Let me just ask you, is the bounce that we're having in a commodities market helping China in any way in terms of the commodities that it exports? Is that giving a boost a little bit to its balance sheets, to its exports, I suppose, to its economy?
Had a little trouble hearing you all just now. I think it's about the policy and the economy development.
Well, no, about commodities in terms of the rise in some commodity prices. Is that helping the Chinese economy?
Yes, well, And such a stimulus will have something to do with the commodity prices. And it can help to drive up some commodity prices because of demand from such sectors such as infrastructure construction. And this will be surely a boost to the commodity prices and some industries too, related to the construction of these projects. And hopefully this will also give a boost to some industries too in the second half of the year. We do not see much change yet so far because China just began to release its 1 trillion yuan state bond. So we hope to see more changes in the coming months.
Okay, thanks, Victor. Laurie, let me go to you. We haven't had an update from you in a while on East Med gas developments, whether it's Egypt or whether it's Cyprus, of course, the whole Israel-Lebanon issue, but again, sort of in the context of also what's going on in the region, has that made investors a bit reticent? Do we see more licenses being awarded? Where are we mid 2024 on East Med gas?
As we remember, like very early on, after like the start of the war between Israel and Palestinians and then Gaza, there were like big announcements from Israel about newcomers into the Israeli market, and so you had companies like BP, SOCAR coming in, and these were, and even Eni, the Italian company. So these were like three big names that entered the market. So that was just an announcement, and after that we didn't hear about signing contracts, etc. But they were the winners of the bid that was open at that time. So that was a big thing. And since then, as you know, like they've been into this the war, but like the flow of the gas is continuing, and it is continuing into the Jordanian market and into the Egyptian market. And that says kind of about the interdependence and the strategic partnership that exists, that is beyond the politics and what's happening in politics, that these flows have continued because they're important for the Jordanian market, very important for the Egyptian, of course. So on the Egyptian side, we are hearing about like every day about new deals, etc., newcomers, because the Egyptian market is in need of new discoveries for internal consumption that is growing, and at the same time for Egypt to be able to export the gas and make money out of it. So this is like one source of foreign currency for the Egyptian economy that is not doing that well. On the Lebanese side, nothing. We're still waiting for end of July, for the beginning of July, to see that if there are companies interested in the offshore blocks of Lebanon. So that will be soon, coming soon, like within 1 month or so. So to hear if there are interest or not. Most probably, there won't be companies coming because of the continuous situation, bad economic situation. On top of it, you have a war that is a very active war on south of Lebanon. And then for Cyprus, the latest was like, again, no agreement between the government of Cyprus and between and the company and Chevron that is on block, what we call the Aphrodite block, that has been for years and years in the making and wanting to produce and to start exploration and production, but there were no agreement on the final development plan, etc. So still for Cyprus waiting as well to move on from discovery to exploration. And of course time is not on anyone's side because of the decarbonization and the future that is not. Maybe gas would have a better future, we don't know, but like we're late. So again, nothing much is happening on that front.
Okay, and in time, perhaps these investors or newcomers may end up going more towards North Africa and leaving the East Med behind if the geopolitical situation doesn't improve and encourage that. There's our survey question for today on the OPEC Plus cuts or not. I mean, of course, we have their meeting in a few days' time, and there has been rumors that they might surprise the market with something before or after the meeting in terms of volumes. So, the question is, what could be the top of the list of these possibilities below? Make deeper cuts, Could that be a surprise, unwind the current cuts in Q3 or Q4 or through to Q4 or none of the above? So could we see an OPEC surprise as we have in the past? Most market sentiment seems to think we're going to be pretty steady as she goes. Maliha, what about in terms of these demand projections? I mean, we saw at the beginning of the year and last year, you know, this divergence in projections of demand. We have a headline saying OPEC is still very confident about second half demand. You know, IEA says one thing, EIA, you know, people talking their own books perhaps, but do we have now, do you think, behind the scenes, a happy medium of somewhere in the middle? I mean, have people settled on that? And really, we're not going to be seeing 2.2 million barrels a day growth in the second half of the year. Is that a possibility?
Absolutely. If you take a look at projections across a host of sectors, most of the people on the equity side have assumed a magical V-shaped recovery in Q4. So there's a lot of optimism on global GDP recovery, US GDP recovery based on Fed cutting rates, stimulus. So the market is actually quite optimistic on a year-end rally, so to speak, which is why we're in a bit of a dilemma right now. I think the disappointment can come in a recession. Let's go back 15 months. Everybody was pricing a recession. That did not happen in 2023. And now everybody's pricing the most economic rosy scenario. So the question really is the debate of the fiscal stimulus. We have had so much money printing for the last 2.5 years, even last year with the SVB regional bank crisis, that has delayed the inevitable recession. We're still in the view that we might see a hard landing / recession slow down. Fed may need to cut eventually, but under the wrong circumstances. The labor market's already showing signs of sort of stabilizing and imploding a little bit. It just there's a lag effect. And I think the US Fed does not comprehend the lag effect themselves. They're patting themselves on the back saying they've done a great job, but we don't think so. So no, going back to your question, we think there could be a great sort of downgrade if we go into recession end of this year, early next year. And that's not been priced in. People are very bullish on across the board.
And what about equities? Obviously, we've seen those being pulled by a certain number of stocks. Obviously, again, liquidity, but again, confidence in the companies, right? I mean, that interest rates are not going to, as they are higher for longer, even are not going to hit the corporate bottom line.
Absolutely. But so the top, 10 or 20 stocks, the technology sector is doing really well. They have a lot of cash on the sidelines. But let's look at all the other names. They're suffering. The small to medium businesses, they can't afford these high rates. We've seen bankruptcies even higher than 2008 levels. So it's such a, sort of dichotomy event where you have one sector doing really well, but the rest of the economy, the real economy, more than 80% of, employment comes from these middle companies, small to middle size. Yes, the profits come from the S&P companies, the top 10 companies, but let's look at the real economy, and that's not doing well. So I think when people look at the index, they get this false sense of illusion of market support, but we don't look at the S&P. We look at every single factor of the market, and it's not that bullish. But the estimates are very bullish for people in terms of this magical recovery. And actually, we giving them benefit of the doubt, the Fed's done no justice. They keep on egging the market even more. So they don't see this coming. But we know the Fed never sees anything coming. 1 month before the GFC crisis, we had all of them saying everything's fine. So we really don't trust the Fed. They are more data dependent.
Okay, thanks, Maliha. There's the answer to the question, what is the most likely surprise? So cuts, that they will actually start to unwind those cuts in Q3 and Q4 equally, which is interesting, actually, because I mean, that's something that obviously, from an OPEC point of view, they'd like to do and get those volumes back. But the price is the issue, isn't it? It's not going to be, they can't afford it to be dropping any more than that. Victor, just to go back to you to close off, we had, not in one of our bulletin headlines, but there was an article I read earlier about China and Japan, and I believe, I forget the last country, but they were meeting together, President Xi and Japan yesterday, shaking hands on something. What was that? Can you recall? There was a headline there. I had it on the FT.
Well, I haven't read much report. Yeah, can you?
Yeah, we
can
can
hear me. Yes.
Yes.
I haven't read any reports on that yet, and it's just kind of normal communication between these two countries, I think. And well, as we know, China's president has been visiting quite a few countries lately. And so we do not expect anything exception in this meeting yet. But we will, learn more about that. Yeah.
Okay, keeping its neutral stance open. I mean, again, with the US, with Japan, with the region, but again, we do see some tension in the South China Sea as well at the same time. Thank you very much, Victor Yang. Thank you, Madiha Bengali, Lori Hatian. Thanks for joining us today on the podcast, and have a great week ahead.
You too. Thank you very
Thanks,
much.
everyone.
Bye.
Thank you.
Bye-bye.
Thank you. Bye bye.